All right, Do Hard Money Nation, I have a special guest with us today, and the whole concept we're going to be talking about is self-directed retirement accounts. And if you're not taking advantage of this, you are missing out. And so I've got a special guest here today, John Bowens with Equity Trust. And John actually started as a real estate investor. So he's been doing deals. He currently holds notes where he's done loans, he's done short-term loans, that type of stuff. And he's been in the self-directed industry for over 12 years. He's with Equity Trust. John, I am super happy to have you here today.
Yeah, thank you so much, Ryan. Really excited to be here as well. Excited to teach, educate, and hopefully help some of your audience listeners learn a little bit more about how to create tax-free profit in a self-directed retirement plan.
Yeah, that's what it's really all about, because a lot of people don't realize when you start investing, you actually have a partner, even though you didn't sign up for one, and that partner is called the government. And they actually put their hands in their cookie jar quite a bit. And this is a great mechanism, legally, doing it ethically, doing it right, where you can actually save those taxes for down the road, or defer them, I guess. Maybe, I don't know, is it a deferral or a savings? What would you say on that?
Well, Ryan, that's the great thing about it is we'll talk about tax deferred growth, but there's also tax-free growth, which you'll hear a lot of folks talk about the Roth IRA, the Roth Solo 401k, and there's some really incredible benefits from a tax perspective in saving, investing in real estate, investing in notes with a self-directed Roth IRA, and leveraging, Ryan, what I call compounding interest in the absence of taxation. So just like you said, eliminating that variable of taxation, which can have magnifying effects down the road for your retirement.
Yeah, and I've personally seen that. So mine is a Roth for the most part. I have mostly Roth money in there. Roth money meaning I've paid the taxes first, and then I put the money in there so that money can grow and work tax-free. And when I take it out, I won't have those taxes. Where the reverse of that is I'm actually using post money from taxes. I don't pay taxes. I let it grow tax-free, and then I actually pay taxes when that money comes out. So any other thoughts on that before we kind of jump into how we can use this?
Yeah, that's a great point, Ryan. So you'll hear of accounts, a traditional IRA, tax deferred account, and then a Roth IRA, which is after tax funded. And you said it absolutely right. A Roth IRA, when you put money in, you don't get a tax deduction. It grows tax free. So as you're flipping properties, as you're lending, buying existing hard money loans or private notes or trust deeds, as you're investing in real estate partnerships, really whatever it is that you're doing, as long as you're following the guidelines and the rules, and you'll find that those guidelines and rules are pretty straightforward and commonsensical, but as long as you're doing all those things the right way, all of your profit is tax-free. And when you take the money out after the qualified retirement age of 59 and a half, you pay 0% tax. In contrast to the traditional IRA, the Roth IRA, you have the traditional IRA. The traditional IRA is funded with what they call tax deductible money or tax deferred monies. So you put money in, you get a tax deduction. It grows tax deferred. And then when you take the money out after 59 and a half, that's when you have to pay taxes. The analogy that is used in the industry is you either pay taxes on the seed or you pay taxes on the crop. Now, the reason why we're so passionate about the Roth IRA, the reason why I personally invest as much as I can with my Roth accounts is because I understand the principles, the financial principles of compounding interest in the absence of taxation. And Ryan, to really give you a real example of this in the real world, I have two clients in St. Louis, Missouri, Kevin and Cynthia, and they started in 2010. So this is right after the aftermath of the financial crisis. Their 401ks, their words, not mine, were absolutely decimated. They rolled over those 401ks into what's called a traditional IRA, and then they converted those funds into Roth IRAs. So they got the taxes out of the way in the seed because they don't want to have to pay it on the crop. Started with $100,000. In 10 years, they've acquired and sold 19 cash flowing properties. They still have today 14 of those cash flowing properties, by the way, in the account.
Okay.
So they have 14 properties. They started with $100,000. All of the profit that's going back into those Roth IRAs is tax-free. And then their words, not mine, they plow it back into more income-producing properties. They do traditional buy and hold rentals. They do buy and sell on seller financing. They do a buy and sell on a lease option to purchase. So they do a variety of different buy and hold strategies. And over those 14 properties, every year they are generating $139,000 in net tax-free cash flow.
Nice.
So for all the audience members out there, $139,000 in net tax-free cash flow, over $1 million in properties and cash flow, starting with $100,000 in 2010. That $139,000 every year, should they choose to do it, because they're over 59 and a half, they can take all the money out and they pay 0% tax. It never hits their 1040 as ordinary income. There's no Schedule E. There's no tax reporting associated with any of that income. There's no long-term capital gains tax when they sell the properties. There's no recapture depreciation tax. There's no installment payment method that needs to be used. It's all in their self-directed, self-contained, self-directed retirement plan that, of course, is all tax exempt. So I think that helps paint the picture for the difference between the traditional and the Roth IRA for everyone.
Well, and for our listeners, one of the things, I first heard this concept, I don't know, 15 years ago, maybe it was even 17 years ago. And the first thing I was like, is this legit? That was kind of the first question that I had. And what I didn't realize is that you kind of had two options. You had Wall Street that was going to go after your money, so you've got all the big bankers and, all the stock and that type of stuff. They're really pushing and having that agenda. And this whole concept of self-directed is just such a smaller sliver of that marketplace, where the idea is, don't delegate your financial success to someone else. Don't just call your broker, give them money and hope it goes somewhere. But I'm the CEO of my own finances. That's the whole concept of the self-directed, is like, if you just want to roll the dice and give it to Wall Street and hope and pray, you can do that. If you want to take accountability and take be the CEO of your finances, then you can say, hey, rather than putting this money and giving it to Wall Street, I'm going to put this money into a vehicle that I can then invest that money the way I think it wants to be invested, using alternative investments that are not stocks or bonds. Now, you can invest in stocks if you want to with your self-directed, but you may choose not to. But I can go make those investments and control that investment and control my own destiny. So that was kind of the first thing that the first hurdle that I kind of had. Any thoughts on that?
Yeah, it's a great point, Ryan, because I was in a similar situation. So 12 years ago is when I jumped into the self-directed IRA business, both feet forward. And I realized that at that time, and this was right after the financial markets just collapsed, and I was in real estate. I was in commercial real estate, worked for a commercial real estate company. And, I saw vacancy rates increase, and I thought to myself, hey, there's got to be opportunity. And with looking at where individuals' retirement accounts are headed, there's got to be opportunity to be able to do real estate investing with a self-directed IRA. Now, my background academically was in personal finance, and my schooling was always stocks, bonds, and mutual funds. So just like you said, Ryan, the traditional stock market route. And so I was conditioned for many, many years to be thinking fixed income securities, annuities, stocks, right? Traditional investments in a retirement account. And someone introduced me to this concept of self-directed IRA investing in real estate. And the first thought that came to my mind was, you can't do it. That's got to be illegal. There's no way that the government is going to permit us to invest in real estate. So then I discovered Equity Trust Company. And I read up a little bit more about the company and the background. And we've been in business since 1974. And our company founder, Richard Desich, put together one of the very first real estate transactions back in the early 80s. And so I read all of these stories and I said, okay, well, it's got to make sense. And then, of course, because analytically, this is the way I am, I need to go directly to the Internal Revenue Code. So I went to Title 26. I went to 4975 of the Internal Revenue Code. I went to the IRS publications. In fact, I went directly to the IRS website. And in the IRS website, I searched real estate self-directed IRA, or you could search real estate IRA FAQ. There's a number of different ways you can get there. And it says in black and white that real estate is a permissible investment. But due to the administrative burden, financial institutions are not required to allow you or permit you to hold real estate in a retirement plan. So that's when, the light bulb went off and I said, okay, this makes sense. The tax code, the IRS publications are telling me what I cannot invest in, not what I can invest in. So when the law was passed back in 1974, the Employee Retirement Income Securities Act, and then all of the amendments thereafter, support investing in real estate, investing in private loans, investing in limited partnerships, investing in really any private asset. You're not forced to invest in a stock market related or an exchange-based type investment. And that's really when it opened up the doors for our organization and a lot of customers to jump aboard and be able to begin using their retirement plans to invest in real estate. So if you're somebody out there, right, that maybe you've never heard of this concept, you might be a little skeptical of it, or maybe you have a financial professional like a financial advisor or CPA that is unsure of it. There's resources out there. There's education, there's information, there's supporting evidence of how this works and how to effectively do it in the right way.
Yeah, I like it. And if you're on the edge, just move forward. I'm telling you, you can get all the resources. You can find these things out, but you don't need to do all the research. It's already done. So the next thing that kind of comes to mind for me. So we started investing, and I can't remember if we were doing. I think we started with the Roth because I'm a big fan of not paying taxes later. I think taxes will just go up over time. But my wife was not excited about it. She's like, why are we plowing this money and what are we doing? You had to kind of get the seed started. But just, I don't know, a couple of years ago, we sat down, we're going through everything. So it's been 12 years. And now we've got a substantial amount of money. And she's like, I am so glad we did this. I am so glad we do this. It's kind of the planting seed mentality, right? You know, the best time to plant a seed was yesterday, right? The second best time is today. So we're really glad that we did that. But one of the things that stopped me is it seemed complicated. You know, like you're talking about words like 401k and, you know, and the difference between the Roth and self-directed and that type of stuff. It's like, it's just too complicated. It may just be easier for me just to send my money to a big brokerage firm. What do you guys provide, or what do you do to make that easy where someone may be unsure about how to do it? Do you guys help walk people through it, or how does that work with you guys?
Yeah, absolutely. So it's certainly not clicking a mouse and buying a stock or mutual fund, right? Buying real estate, private lending, investing in real estate partnerships and such. It's a different approach to investing. Now, of course, the more work we put into it, right, the more we're going to get out of it. And when you look at the risk to reward spectrum and you look at real estate investing, obviously there can be some incredible opportunity. Now, of course, I'll mention that just like the stock market, there can be risk as well. But for a lot of our investors, a lot of our clients that come to us, some come to us with a lot of real estate investing experience already. So the idea is take their retirement plans that have been producing, in their words, usually not ours, producing substantially lower returns than what they can make in the real estate market, and put it into those real estate investments to start driving their yield, right? And as you know, Ryan, the rule of 72, if we take 72 and we divide it by our return on investment, that gives us the number of years we're going to double our money. Well, I have investors that started making 7.25% in the stock market, and now they're making 30% return on investment fixing and flipping real estate. That's not buying real estate through us. That's them finding deals on their own, conducting those real estate purchases, and achieving that desired rate of return. So 30% return on investment is the last one that comes to mind of a local investor in Cleveland that just fixed and flipped the property in their self-directed Roth IRA. And so when we do the numbers there, 72 divided by 30, right? They're doubling their money just about every 2 years or so, compared to they were doubling their money every about 7 to 8 years prior to that.
Yeah.
So for a lot of active investors, it's about driving the yield of their existing retirement plan. For those that have no experience at all, I have a lot of investors that they do their very first real estate transaction with their self-directed retirement accounts. In fact, the very first real estate deal that I ever did, it was a private loan. And I did it with my self-directed Roth IRA. It was a $23,000 loan that I loaned to a real estate rehabber in Tampa, Florida. And I charged 10% interest. And in 6 months, I got my money back. So I made 5% of my $23,000. I put it back into my self-directed Roth IRA. I didn't have to file a tax return for it. It was tax-free in my Roth IRA. And then what do you think I did? I went back and I made another loan. 5 days later, I redeployed that capital, my $23,000 that I had from the previous deal plus my interest. I plowed it back into another deal. And so for investors that are brand new, investing with a self-directed IRA can be a great way to get your start in real estate. As far as to address, is it complicated? How does it work? Equity Trust as a custodian, this is what we specialize in. So we offer the technology system, the bookkeeping systems, the tools. We have over 400 associates that service our over 100,000 customers. So you call us, we walk you through the process over the phone. On the front end, I have a team that supports me, in fact. And what they do all day, every day, is they talk to investors that know nothing about self-directed IRA investing, and they actually coach them through the process of how it works, how to open an account, how to fund account, how to transfer money over, how to make sure when you're transferring or rolling over money, you're not creating a tax consequence or penalty. A lot of people are fearful of that. They go, oh gosh, I've had my IRA with so-and-so for all these years. If I transfer or roll it over, am I going to be taxed or penalized? You're not. You'll find you're just moving from one bank account to another. So we walk investors through that entire process. And then as far as executing on a real estate purchase or a private loan or a real estate partnership, we have technology systems that allow our customers to, in a digital way, in a digital environment, process all of their transactions from end to end. And really, buying real estate in a self-directed IRA is no different than buying a stock or mutual fund from a conceptual perspective. So when I buy a stock or mutual fund, cash leaves my account. In return for that cash is a stock certificate. When I buy a property with my self-directed IRA, it's the same concept. Cash leaves my account. In return for that cash is a deed to the property. There's no taxable event. There's no penalties. It's just moving money out to a title company, and then in return is the deed to the property. That's the actual collateral. Expenses related to that property, taxes, insurance, utilities, property management fees,
Rehab.
any costs, rehab, etc. Right? All of those expenses are paid for from the IRA, and then all profits go back into the IRA. And when all profits go back to the IRA, it's exempt from taxation. And that's the beauty of the Internal Revenue Code, is exempt from taxes. Just like dividend income in a stock, or you sell a stock, you have capital gains that come back in. You don't have to report that income. You don't have to report those gains on any type of tax schedule or on your tax return. The only time you report on your tax return is when your IRA, you've taken a personal distribution from it, or you're making a contribution. But as you're buying and selling real estate, as long as you're doing everything properly, there's no Schedule E, there's no Schedule C, so on and so forth. Great example, Ryan, is back in March, so March of 2020 here, I bought a rental property here in Cleveland, Ohio for $63,000. And I funded this deal, and this gets a little bit interesting. I might be getting a little ahead of myself, but I'll bring it up anyways for the audience members. I funded this deal, $63,000 double. So it's a rental property. I plan on buying and holding this property for 5-10 years at least. I partnered my Roth IRA with my traditional IRA with my non-IRA money.
Wow.
So I bought the property for $63,000. 55% is owned by my Roth IRA. 35% is owned by my traditional, and then I own 10%.
Perfect.
So it's a three-way partnership, if you will. And it's important to bring this up because if I don't have enough money in one of my individual accounts because I have other assets, or maybe I just don't have any cash in there, right? And I'm sure a lot of folks out there that are like this, I can partner my IRA money with myself, with my non-IRA funds. Now, I got to make sure I do everything properly and proportionally.
And clean. Yeah, keep it clean.
Exactly. I'm 55, 35, and 10. So all my profits and all my expenses flow 55, 35, and 10. But I'll tell you, Ryan, my wife also has a Roth IRA. She has a traditional IRA. So I could also partner with her IRAs on deals. And the reason why I bring this up is because I think it's important for everyone to know that there are ways that you can carve up transactions. There's ways that you can partner on deals, and not just partner with your own money, but also partner with other investors. For example, I'm looking at a property right now here in Cleveland. It's a fix and flip deal, $82,000 purchase and rehab, ARV of 122. I'm going to make a $46,000 offer. The reason why I'm doing this deal is because I want to grow my wife's Roth IRA, which has only got $5,000 in it, in a very meaningful way in a short period of time. And here's what I'm going to do. I got an investor friend of mine by the name of Mike. And Mike's, he's a money partner investor. So he's not someone that is looking to own real estate, be involved in the negotiation, be involved in the oversight of the project. He just wants to invest his money and get a good rate of return. And so what we've agreed upon is a real estate joint venture where my wife's Roth IRA is going to bring in $5,000 for the $82,000 purchase and rehab deal.
Okay.
Mike's bringing in $77,000. We're creating a joint venture. I have a real estate attorney do a joint venture agreement for me. We're going to split the profits 50-50. This property has $30,000 in profit potential, which means when the deal's all said and done, my wife's Roth IRA will make $15,000 in profit with a $5,000 investment, growing her Roth IRA from $5,000 to $20,000, all tax-free, of course. And then Mike is going to make the other $15,000. He invested $77,000. He made a 19.5% return on his money.
Yeah.
So Mike's happy because he's a partner in the deal and is making 19.5%. My wife's Roth IRA and myself were happy because we're growing the Roth IRA in a meaningful way in a short period of time. And the
Yeah.
reason
I
why I
love it.
bring this up is because it's a great lesson that even with a small amount of capital in a self-directed IRA, there are ways to do meaningful transactions in a very short period of time.
Yeah, absolutely. Next time, tell your wife to call me because I'm interested in that deal too.
Yeah, I will.
No, I love it. It's a win-win for everybody. The lender gets more money than he normally would. Your wife's grows. I mean, we've seen the same thing, what we call gap financing, where you've got somebody that's got 5, 10, maybe $20,000, and they actually bring the money, and somebody else is getting a loan. There's a gap of $20,000. Let's say they do a joint venture agreement, do a profit split, or do an interest rate, a set interest rate, equity or loan, however you want to do it. So I love that. Let's really quickly, you touched on this just really quickly, but the rollover, we don't want to spend a ton of time because I want to get into all the different uses for how we can actually use the money. But you can roll, if somebody's got something in a brokerage firm or whatever the case is, they can roll that over into a self-directed. Just get with somebody like Equity Trust that can do all that for you. Talk to them. But if you have money sitting somewhere else, you can take that over into a self-directed. I just want to make sure everybody understands that point. But what I want to know, John, what are all the different things? I've read the list before. I know it's really long, but what are all the different things the money can be used for within a self-directed? We're gonna forget some, but the big ones. What can I use the money? What can I invest in?
Yeah, absolutely. So let me start with real estate because that's what we've been talking about, and that's the focus, of course. So in real estate, fix and flip, buy and hold. I can tell you that about 80% of real estate investors I find when they own individual properties, they're rentals. The other 20% are flipping in terms of self-directed IRA investing. 50% of our real estate investors are actually lending money secured by real estate. So their IRAs are issuing or originating promissory notes and mortgages or deeds of trust. So they're originating. And then there are also investors that are buying existing commercial promissory notes, trust deeds, mortgages. So, of course, there are firms that will assist and facilitate they originate loans, so commercial lending to rehabbers, real estate developers, gap financing, mezzanine financing, right? Just plug and play the terminology you want to use. And then to add liquidity to their capital fund, right? They sell those mortgages to investors. And so self-directed IRA investors have found that to be a very attractive way to passively invest with their self-directed retirement dollars. So it's not just holding individual properties, it's also the private lending side. The key advantage to all of this, of course, as we've been talking about, is tax-free and tax-deferred profit. The reason why I have found private lending with my self-directed IRAs so attractive over using my non-IRA money is if I loan money with my taxable dollars, I am subject to paying ordinary income tax rates on that interest income. It's just like if I put my money in a savings account, right?
Mm-hmm.
I get a 1099 from the bank and I got to pay taxes on that at my ordinary income tax rates. So I'd have to pay 30 cents on the dollar on all of the interest income. When I loan with my self-directed IRA, Roth, traditional, solo 401k, plug and play the account type, doesn't make a difference. All of that interest income is tax-free. In 2018, I had just over $11,000 in interest profit from private lending. I paid 0% tax. Had I done those deals outside of my IRA, I would have paid nearly $3,500 in taxes. So using self-directed IRAs allows me and allows a lot of our clients to ultimately increase our yield. By increasing our yield, we can ultimately get to our retirement goals faster. Real estate partnerships, so LLCs, limited partnerships, think apartment building projects, multifamily, shopping centers, other commercial type properties, storage facilities is a big one, mobile home parks. I have an investor recently who invested in a partnership. There are 14 investors involved. They're buying a mobile home park. His IRA is an equity partner in the LLC that's acquiring this mobile home park. So there's an operator, a syndicator who's putting it all together. The IRA investor, our client, is simply a passive investor in the deal. He has an ownership interest in that LLC, and he'll receive preferred returns back into the IRA. And then in 10 years, they plan on selling that property. The acquisition here in rehab is about $5 million. They intend on selling it for $15 million, making a $10 million profit in over 10 years. And he'll receive a percentage of that profit. which will go back into his IRA. Real estate options is another one, wholesaling. So you can wholesale, you can do real estate options in your self-directed IRA. Another investor friend of mine, Scott, he recently did a real estate option deal where he put $2,000 down to secure a property. It's actually a storage facility, so commercial property. He has the right, not the obligation, to exercise the option. So buy the property at a future date at a predetermined price. His option fee, Ryan, was $2,000.
Okay.
And he assigned the option to an investor buyer, and he made $20,000 in his Roth IRA, all tax-free.
Perfect.
So we talked about private lending, holding real estate. Beyond real estate investing, we do permit customers to invest in other alternative assets, we refer to them as. So alternative being alternative to stocks, bonds, and mutual funds, such as, but not limited to, precious metals, so gold and silver, cryptocurrency, investing in equipment financing, equipment leasing, structured settlements, investing in even things like alpaca farms and tropical tree farms. We've seen some very unique and exotic investments. The IRS and the government, when they wrote the tax code, was exclusive. They told us what we can't do, not what we can do. So we always say that you're only really limited by your own creativity. And in addition to all the alternative investment options, we still do have the technology platforms for people to still have exposure to stocks, bonds, and mutual funds. Now, we're a non-fiduciary, non-advisory custodian, which means we don't provide tax, legal, or financial advice. We never would, whether it's in real estate or traditional investments. So we're not going to tell people what stock or what mutual fund to buy, but we give that option to our customers in case they still want some diversification or exposure to stocks, bonds, mutual funds, ETFs. So we have the technology systems and the plugins within the online account access in order for people to still participate in those types of investments.
Yeah, it makes a lot of sense. Well, a couple of things I just really want to point out as you talk about structuring some of these deals. One of the things you can do is go to mom, dad, grandma, a brother, whatever the case is, who has a 401k and work with them to roll over their 401k into a self-directed while you're doing the same thing. So you have more capital to be working with. So there's a lot of power in that because there's a lot of what I like to call lazy money out there. It's money that just isn't working, isn't getting a good enough return. So there's obviously joint venture opportunities on that. The other thing, just a quick disclaimer, is with all of this, you've got to do your own due diligence, so you've got to make sure equity, we're not going to go find a deal for you type idea, right? Like you've got to go find your own deals. You've got to make sure it's that, and you got to do your due diligence to make sure it's a good deal. What this provides is a vehicle to do that in that tax-free environment. And when that happens, the compound effect, when you compound with what you saved in taxes, makes it even better. So one quick question before we wrap up here. What if somebody found themselves in need of some money? They put all this money in there, they need some money. How can they get access to that money? Do they get taxed on it? What's the quick answer on something like that?
Yeah, so the rule is if you take money out of a retirement account, IRA, 401k, Roth, etc., prior to the qualified retirement age of 59 and a half, you have a 10% penalty and ordinary income taxes on that withdrawal. That's before 59 and a half. If you really need to take the money out, you could take the money out. You're just going to have to pay taxes and a penalty. Now, there is the CARES Act, coronavirus-related distribution. You have to qualify for it. I want folks, and I'll only mention it briefly, to be very careful with that CARES Act coronavirus-related distribution because people are using it, unfortunately, I've seen, as a license to raid their retirement accounts and then use the money to go out and invest, and they pay taxes on that amount.
Yeah.
Why not do the deal in the IRA and not pay taxes and not have all the bookkeeping, record keeping, and schedules and tax returns that you have to file that go along with that? So keep it in the IRA and keep it growing. Now, once you are 59 and a half or older and you take money out, if it's a traditional IRA, you have ordinary income taxes. If it's a Roth IRA, like in Kevin and Cynthia's case, who I mentioned before, it's all tax-free. So the Roth is obviously the preferred vehicle over the traditional, but the traditional still has that tax-deferred growth benefit. And for somebody that's got a 401k that's all tax-deferred and they're earning little to nothing right now and they want to take action in real estate, it still makes sense to self-direct a traditional IRA. But yes, if we can get into that Roth environment, it's great. The last thing I'll mention about taking money out of an account prior to 59 and a half, if you have a Roth IRA and you make contributions to that account, whatever monies you distribute or whatever monies you originally contributed to that Roth IRA, you can distribute at any time tax and penalty free. So it's sort of like a safety net, Ryan. Let's say you put in $5,000 into a Roth IRA and you put in $5,000 to your wife's Roth IRA, which, by the way, I don't know whether your wife works or not, but let's say in this case that your wife does not work. She doesn't have any earned income. Well, Ryan, I know you have earned income, so that's okay. As long as you and your wife are married filing jointly, you can set up a Roth IRA for her as well. And being under the age of 50, you can both contribute $6,000 to the account. Now, with that, let's say you do 6 for you, 6 for your wife. You got 12,000 total. And let's say 6 months down the road, a year down the road, 2 years down the road, even though you and your wife are under 59 and a half still, you really desperately need that money that you originally contributed. With a Roth IRA, one of the benefits is you can always take that amount out that you contributed, totally tax and penalty free. And so why more investors, why more Americans don't put their savings into a Roth IRA absolutely baffles me. We see people hoard money away into savings accounts. They pay taxes on the interest, right? They pay taxes on the interest.
Which isn't much interest, but yes, they still pay taxes on it.
Correct. Instead, put it in a Roth IRA. Also put it in a Roth IRA because you can only contribute $6,000 when you're under 50 every year, $7,000 when 50 and over every year. Now, earnings and growth is unlimited.
Yeah.
So when we talk about real estate investors doing deals and making $15,000, $20,000 on a real estate option or a wholesale deal, that can be great because they can still grow it in a rapid way. But if you're somebody that's just getting started, just making contributions, I think you said it good, Ryan, which is the best next time to plant a seed is today. So contributing to a Roth IRA gives you the ability to take that money out at any time if you have an emergency situation.
Yeah, and like you said, it's got to be a real emergency, like a serious medical condition, a family member that has something serious. We're not talking that you want to go on vacation or, the whole goal with this is to have compound interest in a tax-free environment that continues to grow. That's the whole thing. As much as you can plow in there, making good investments as it grows, that's the whole goal with this. So, well, awesome. John, we're out of time. This has been fantastic. We could go, I forgot to mention, we need to say one thing. If you're a business owner, there are lots of things you can do as a business owner where you can provide this type of environment, not only for you, but for your employees, and have the ability to contribute a lot more money than you'd normally be able to in your own account as well. And Equity Trust can hook you guys up with that as well. So if you're a business owner, I strongly encourage you to check things out. Any final thoughts you want to share with our listeners?
Yeah, what you said is a good point, Ryan, which especially for real estate investors, there's an account type called a self-directed solo 401k. It's similar to an IRA in many regards, but different in respect to being able to contribute more money into the account. In fact, with the solo 401k, you could potentially contribute up to $50,000 or more when you're under the age of 50 and up to $63,500. And there's what's called a Roth component to that. So you could potentially get upwards of 3 to 4 times more into a Roth environment with a solo 401k. And we have additional YouTube videos and training on that as well, of course, so folks can take a look at that. But that's important for business owners to take note of, that there are some other retirement accounts out there that they can potentially access, and that could really optimize their success as a real estate investor. And there are 2 other self-directed investment accounts that a lot of people don't talk about or are familiar with, which is a Coverdell Education Savings Account and a health savings account. So it goes beyond just retirement savings. We also show people how they can save in a tax-free environment for their children or grandchildren's education, K through 12, as well as college tuition. And then also for healthcare expenses for folks that have a high deductible healthcare plan and qualify for an HSA. What's really neat about the Coverdell Education Savings Account is you can grow and create wealth tax-free, just like a Roth IRA. And to give you a quick example, I have a client in Nashville, Tennessee. He bought a vacant lot for $8,000, partnering his 3 children's Coverdell Education Savings accounts. Each Coverdell Education Savings account kicked in equal proportions for the deal for the $8,000 purchase. And then they sold the lot and they made a $50,000 net profit. Now,
Wow.
They didn't do anything. They didn't develop the lot.
Didn't improve it.
Didn't improve it, didn't pay, all they did is pay some taxes, right?
Yeah.
Some prorated taxes, but they bought it and sold it 60 days later to a developer and they made a $50,000 profit. And so he made $50,000 tax-free, never hit his 1040 as ordinary income. That's an extra $50,000 that he has for those children's K through 12 education or college tuition. So the only thing I'll leave folks on is you can get really creative in private lending, from wrap loans to equity participation loans, real estate joint ventures. Think just about anything you can do outside of a self-directed IRA, anything you've done before, you're looking to do. For the most part, you can do with a self-directed IRA. And we, of course, can help folks through that process, right? So, hey, can I do this? Can I not do this? How does this work? What are the rules? Who can't I invest with? Who can I invest with? We could certainly cover those items with individuals. And we have YouTube videos and other information for folks to consume as well on their own time.
Fantastic. Well, John, thanks for being with us today. One thing I'll just leave is saying, hey, we've thrown around a lot of names and terminology and everything else like that. Don't be intimidated. Pick up the phone, call Equities. Here's where I'm at. You don't have to know everything to get started. You just have to know somebody that knows it to get started. And that's, I think, a big key. So pick up the phone. Don't be afraid of the terminology. Say, I want help. Here's what I've got. Here's what I want to do. And Equity is a great place to do that with. You can check out Equity Trust. They've got YouTube videos. Equity Trust Company is their YouTube channel. And you can go to their website, which is trustetc.com. Again, that's trustetc.com. You can check them out. John, thanks so much for being with us today.
Thank you, Ryan. Appreciate it.